Hello, everyone. On behalf of the Councils of Real Estate, welcome to this presentation of Four Continents, Four Perspectives, and thank you so much for joining us. My name is John Bucheski, and I'm the 2026 Global Chair of the Councils of Real Estate and President and founder of Real Estate Fiduciary Services, which is located in Somerville, South Carolina, in the US. The Councils of Real Estate is a global organization of commercial property advisors and has long been a beacon of thought leadership and problem solving in our industry. The 900-person organization's strength lies in the diversity of expertise and experience among our distinguished members, those that have earned the prestigious CRE designation. Please visit CRE.org to review our membership criteria to determine whether you too might be interested in joining our organization. And at the same time, you can subscribe to our peer-reviewed journal, Real Estate Issues, which is free. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed, and we'll answer as many questions as time allows. I'd like to introduce today's moderator, David Levy, CRE. David's expertise encompasses the development and assessment of real estate investment strategies for high net worth and institutional investors, while serving on investment committees, assembling and leading high performance teams, and implementing comprehensive property valuation processes. He's currently a managing partner with Milestone Investment Research in Lincoln, Massachusetts, and spent many years at Bentall Green Oak, now known as BGO. Welcome, David.
Thanks, John. As John said, I'm David Levy, a CRE in the Boston area and a member of the New England chapter. I'm also chair of the Councilor's Virtual Programming Committee, which brings you these What's Next webinars. Today we have a large international audience, so good morning, good afternoon, or good evening, depending upon your location, and thank you for joining us. Today we have four counselors of real estate from four different regions of the globe, sharing their perspectives on current and anticipated market conditions within their respective geographies. We thought this format and its timing would be insightful and complementary to our other recent virtual programs that have included Emerging Trends in Real Estate, the Year in Review, as well as the ongoing Specialty Interest Group, SIG, deep dives related to the Counselor's Top 10 Issues Affecting Real Estate. The Counselor's Top 10 Issues 2026 Outlook, consistent with surveys and forecasts from other industry participants, highlight multiple themes, risks, and structural changes facing global markets that include a list of deglobalization, geopolitics, artificial intelligence, infrastructure, and power and energy transition, inflation, interest rates, and central bank monetary policies, pricing risks, demographics and immigration policies, return to office, housing affordability or attainability, and many others. We won't be able to address all of these issues today, but all these trends have varied near, medium, and longer-term impacts on real estate markets, investment preferences, capital flows, and return expectations. Now, I'm anticipating that you might hear not all global markets and regions are in sync. And if so, these insights can help you better understand today's varying global real estate cycles, risks, and opportunities, as well as navigate investment and capital allocation decisions and recommendations on behalf of your clients. Over the next hour or so, our roundtable of experts will compare and contrast variations in these trends and outlooks across North America, Europe and the UK, Asia Pacific, APAC, and Central and South America. During the session, please post any questions you may have in the Q&A feature at the bottom of the screen. And we'll try to answer as many questions as possible toward the end of the session. So I now ask each panelist to introduce themselves and the region they represent, and to get us started, also highlight some brief introductory thoughts about what you're looking forward to and where you see headwinds regarding your respective markets. Richard, would you like to kick things off?
Yeah, well, look, thank you very much, David, and good morning. I'll say good morning because I'm in suburban Dallas, and uh, I've been a councillor since 2018. I'm proud to be one. I have recently stepped down as chief economist of CBRE, and I'm focused on academic pursuits at Harvard University and the University of North Carolina. Anyway, that's me. So, what am I thinking about the region, North America? Obviously a period of change and a lot of political headlines. But if you look under the hood a bit, the economy is motoring along quite nicely, with pretty high levels of GDP growth, pretty good levels of consumer spending growth, good investment, and we're looking at fiscal expansion in 2026 as well. So it bodes well for a good year in the US economy. And with real estate, I would say, in the United States, we're probably a year or 18 months into a new cycle. Now, with all of the disruption that AI is going to bring, and every cycle, every real estate cycle is both the same and different. We don't quite know what the shape of this particular cycle is going to be, but we see in all sectors vacancy rates beginning to trend down, and rental growth is very subdued, but fundamentals are improving in US real estate. And with the weakness of the dollar, I think there's some opportunities potentially for overseas investors to deploy capital. So those are the brief initial thoughts, and they're relatively positive. But I wouldn't be an economist if I didn't have a few negatives to throw out there. A short-term negative, I suppose, is just consumer confidence. I've talked about consumer spending growth, but it's a bit of a jobless recovery, or a period of jobless economic growth in the United States, and I think that's undermining consumer confidence. And certainly, there are big portions of the consumer world that are not feeling an improvement in standards of living. And that makes the economy vulnerable. I think the high value of the stock market, if that got a jolt, that could make the economy vulnerable as well. So those are risks in the near term. Longer term, I'm concerned about the continued federal deficit and the build-up of debt to GDP ratio in the United States, in particular because that could impact on the bond market. And at any point, you could see bond yields spiking, and of course that would feed through into appetite for real estate. And I think that the gap between real estate cap rates in the United States and bond rates is still on the slim side. I think for domestic investors, which is constraining, I think, a full-on recovery in investment markets. So that's my thoughts to start with. Back to you, David. You're mute.
I'm sorry. Thanks, Richard. Nick, would you like to go next?
Yes, thank you. Hello, everybody. I'm Nick Hatzitsolis. I'm chairman of Axis SA. Axis SA is a CBRE affiliate firm based in Athens. I'm active in the local market and the Balkans for more than 35 years. And in the 90s, I chaired the RICS Europe. I have been a CRE since 2007. I'll talk about Europe, which is now in a state of recovery as far as the real estate sector is concerned. Europe's recovery has continued through 2025 and into this year, despite turbulence in the financial markets. Inflation is easing, sentiment has improved since the COVID period, and investment is expected to strengthen. Lenders remain active, supporting the rebound through income-focused strategies. Most property sectors are performing well, with the living segment leading the market. However, this momentum also highlights growing social pressures, particularly around the housing shortage and housing affordability. At the same time, geopolitical tensions, tariffs, and broader microeconomic uncertainty have a negative impact on confidence, thus slowing growth. These risks remain significant and continue to be a source of serious concern. That's it for me. Thank you.
Thank you, Nick. Giancarlo.
Yes, thank you. Good morning, everyone. I'm Giancarlo Nicastro. I'm a CEO of Sila. I have been a CRE since last year. Our focus on real estate strategy and market intelligence across South and Central America. I spend much of my time analyzing how capital flows, pricing adjustments, and structural demand trends are reshaping investment opportunities across the region. I'm glad to contribute the Latin America perspective to today's global discussion. So what we are looking forward here, macro stabilization is gaining traction, monetary easing cycle already underway, selective returns of cross-border capital, particularly into Brazil and Mexico, structural demands, and energy and renewables leadership. Countries like Brazil and Chile are well positioned in renewables, which supports industrial growth and long-term infrastructure investments. So we are worried about political and fiscal volatility, currency risk, sensitive to US monetary policy, and pricing dispersion and capital structure risk. This is a year of selective opportunities, not broad recovery.
Thank you, Giancarlo. Yasushi.
Hi, thank you, David. Good evening from Tokyo, Japan, because I'm at around 11 in midnight. So I'm talking about Asian Pacific market, and the keyword for the Asian Pacific market is divergence. The APAC is no longer a single synchronized. Oh, sorry, I forgot to introduce myself. I'm the co-founder and also the representative member of the company called Eminence Partners. And I'm helping out global institutional investors investing into Japan real estate market and finding out the deals and also arrange the financing and also provide asset management. That's my bread and butter. And also I'm serving as the vice chair of the APAC chapter of CRE and also assistant editor of real estate issues for CRE. So today I'm talking about the APAC market. So APAC market is a huge market. India, China, and the rest of the Southeast Asia and Oceania. And so as you can tell, our defining theme is divergence. APAC is no longer a single synchronized market. It has become a collection of multi-speed economies, and each reacting differently to the current cycle. And positive in the Asian Pacific market is that Japan still remains the primary anchor of the region. The narrative has successfully shifted from the cheap debt to organic rental growth. In Tokyo, the really tight supply of grade A offices and explosive growth in hotel RevPAR are providing a crucial buffer. The income growth, NOI growth, is effectively offsetting the upward pressure on cap rates from the Bank of Japan, monetary normalization. And also Taiwan, Korea, Japan's are creating a so-called AI corridor. And the explosion of the semiconductor manufacturing and the data center requirements is creating a robust floor for industrial and R&D assets in those countries. This isn't a speculation, it's real. And physically demand driven by the global AI revolution. And Australia and Singapore, extremely supply side discipline is existing. So the vacancy is extremely low in CBD and also Australians' logistic assets. So that will create like a really immense pricing power for landlords. The pessimistic side of the market is that it's now shifting from the interest rate anxiety to credit and geopolitical friction in the region. And one example is in Korea, there's a systemic stress in the Korean project financing. So the delinquency rate among non-bank lenders responding a liquidity bottleneck, and the government is implementing the soft landing policy, but nobody knows how it goes. And at the same time, many of you are aware that China is going through the structural difficulties. And it's not the cyclical downturn anymore. It's more like long-term structural adjustment because they built too much. And although the stimulus efforts has been done, but nobody can tell what's going to be happening, and which will have a significant impact on regional economy. And lastly, the geopolitical risk premium. We must acknowledge the geopolitical premium in the region and APAC region. And although like semiconductor manufacturing is boosting like demand for the buildings, but still we have to incorporate like geopolitical risk into the cap rate. So that's the starting point for Asia. Thank you.
Thank you, Sushi. Thank you all for your comments. Let's take a deeper dive into some of these themes and issues you've all identified. I want to start with geopolitical risks and social unrest because that seemed to resonate throughout. So what are the impacts of these events on real estate? There's a pausing decision-making investment activity? Is it, Sushi already referred to some of the pricing premiums that are happening, especially with Taiwan. How about selection of real estate markets and property sectors? There's some recent headlines I saw kind of on the heels of some recent rhetoric and shifting U.S. policies where the European and Canadian institutional investors are pulling out of the U.S. due to political uncertainty. So what are you seeing and anticipating in your respective markets? Richard, you want to start?
Yes, okay. So, sort of geopolitical risk and social pressure does get quite a lot of airtime on the media. I'm not 100% certain that I'm seeing anything particularly impactful in US real estate markets at the moment. In terms of fundamentals, in fact, the post-COVID crisis hangover, I think that affected many downtown areas of American cities, now seems, thoroughly to have been shaken off. And there's all manner of sort of, indications that American downtowns are coming back to life. And it's not just in terms of office occupation, although that is improving. It's in terms of kind of, pedestrian footfall and, opening of restaurants and all of the things that kind of make a downtown, habitable and a pleasant place to go. So I'm not certain I see so much actual direct impact in terms of unrest on US real estate. But I think the big thing geopolitically is just the trend in all of the advanced economies against migration, against migration. And it's brought to, that kind of anti-immigrant feeling is brought to power, governments that are, less globalist in thinking and more kind of nationalist in thinking. And, if there's going to be an impact of that, it'll be in terms of foreign capital inflow into the United States. And Canada, for instance, has kind of borne the brunt of trade tensions, I think, that have emerged in the United States. And Canada, Canadians were the largest source of foreign capital into US real estate over the last several years. So actually, I think the decline of the dollar and the positioning of the US cycle, and with vacancy rates coming down, there are actually some very good opportunities in US real estate. And I think that would go for all sectors. Admittedly, there would be different risk profiles with all sectors. But it remains to be seen. We just don't have the data. We'll see this year whether it has actually been the trade tensions, the geopolitical tensions, the apparent social unrest, will actually have put off investors. I think investors will be, worried about the headlines, but probably looking at potentially, good opportunities. We just don't know. We just don't have the data yet. But but I would expect to see, I think, on balance, a decline in foreign capital deployed in US real estate. Perhaps not that much, but I would expect to see some sort of decline, which of course creates opportunities for domestic investors. And that's what we've seen. I think investments, transactions up 17% in 2025, albeit we're nowhere near the levels of 20 and 21 yet. We're seeing domestic investors, increasingly committing in perhaps in some of the spaces that overseas investors would otherwise have been. But it is actually a good opportunity for overseas investors to deploy in the United States right now.
Nick, what are you seeing across the European markets and UK?
Well, I'll take up what Richard has just said about that 2026 will show, I think, some kind, hopefully, of stabilization. The dust will settle, and we'll see how the property market will perform in both sides of the Atlantic, at least for this region of the world. I think Europe is a little bit scared with the possibility of tariffs implementation, with geopolitical uncertainty. And though it is now in a new cycle, we see some kind of slower economic growth with risks. Just to say that the growth this year, as compared with last year, it has fallen about 4 decimal points, for 1.3 to 1.1%, which shows some kind of inability to perform as good as in 2025. So this new cycle in Europe may bring better prosperity in the property market, and we may see a situation that we'll see better lower yields and better performance of all sectors of property market. Just to say also that US investors do indeed invest in Europe. Real estate investment from the United States has increased, but the type of investment has shifted. For example, the US investors increased exposure to Europe, but selectively and with hedging. Foreign direct investments go mainly to Ireland, Germany, the Netherlands, and France. And we also have short-term capital flows that are cyclical, and they help the strong euro as against the dollar. So perhaps American investors feel more secure in investing in real estate market with this moderate growth that we see around. In Europe, we've seen that several sectors of the property market appear quite attractive to investors, such as the multifamily and industrial, and with the offices rising at the moment. Well, I've just given some positive and some negative issues for discussion. And something else, the MSCI, which is the Europe's flagship index representing the large and mid-cap companies, is constantly increasing, showing that there is trust despite the geopolitical turbulences. And even if we compare what has happened in the last few weeks, the MSCI has gone up, now stands at 2,815, and has shown approximately almost 0.1% increase per day in certain days of the last couple of weeks. So this is pretty positive and gives confidence to potential investors in this continent. I can talk, if you wish, perhaps later, what are the best cities and what are the best countries to invest, and give you some figures, but that can be done at a later stage.
That sounds good. Yasushi, you had already made reference to some of the geopolitical impacts, particularly around Taiwan. You want to elaborate any within the APAC or Oceania?
In general, like U.S. tariff issue has not been strongly impacting the Asian market because we don't see a lot of countries that suffered from the downturn of economy because of that. Japan is also, we believe things are settled down somewhat. So we don't see a negative outlook from that. Having said that, and also we don't see any change of the capital flow into the region because many Asian countries are dollar-pegged country. So the easement of the U.S. dollar interest rate will allow like a liquid flow of capital into those countries. And obviously, having said that, still mainland China and North Korea are like epidemic of like issues. And so surrounding neighbor countries, as I mentioned, Taiwan and South Korea. And in extension of that, Japan's are like facing really sensitive situation. And particularly, I mentioned to the semiconductor and manufacturing businesses in Taiwan, but the same thing is happening in Korea because the Seoul, which is the capital city of Korea, is really close to the border against North Korea. And also, there's our prime minister's statement created like a really strong political tension between Japan and China last November. And this January figure showed that Chinese tourists to Japan went down to 60% in 2 months. So that created a significant downturn for the booming hotel assets. So now we need to understand that we are on the really sensitive balance. But it's not that, regarding Taiwan, maybe cap rate includes some kind of long-term anxiety for the geopolitical issue, but I don't see the one in Japan yet. So that's like my personal observation. So yes, we need to go with caution, but it's not that negative yet.
Giancarlo, what kind of geopolitical and social unrest issues have risen in Central and South America?
Yeah, in Latin America, geopolitical and social risk are less about immediate crisis, but more about volatility and policy direction. Political transitions, fiscal constraints, and growing social pressure, especially around housing affordability. But for investors, that means underwriting not just market fundamentals, but also the policy risk.
Let's move on and integrate sort of the outlook of central bank monetary policies and the impact on interest rates. Post-pandemic, the inflation's declined globally since 22. which has left a lot of varying impacts on interest rates, currency exchange rates. Most central banks have performed monetary easing through last year. The US, Canada, Europe, UK, Korea, Singapore, Mexico, and I guess Brazil is expected to ease this year. And most are now in neutral stance, but Japan is tightening, trying to curb inflation, weaken the yen, and I guess also in Australia. So what are the impacts on global capital flows or the availability of debt and liquidity? I know we have a credit crisis in Korea. So any reflections on what it means for capital flows as well as sort of is Tokyo a bargain right now for global investors given where the yen is?
Yes. Yeah, I think still in Japan, you can get the positive leverage from the non-recourse debt. And although the interest rate is tightening, but still our 10-year government bond interest rate is only 1.7% because we increased from 0 to 1.7. That's why people are screaming. But as a global level, it's still very low interest rate. And because of new new prime minister's policy to stimulus package, people concerned with like the government debt issue. That's why like yen is gets although the interest rates going up, still the yen is getting weaker. So I think a lot of capitals outside Japan is, as David just pointed out, it's a bargain. So please come to Japan.
Giancarlo, how about your markets?
So in Brazil, the interest rate is around 15%. And in Mexico, it's around 7%. We are looking forward a easy cycle coming. We have the inflation under control. But what happened here, we are seeing more political risk than the rest of the fundamentals of real estate. We are seeing companies from US and foreign capital going outside of Brazil because the political issue here that we are facing. We don't have strength to guarantee returns. Even those returns are higher than the rest of the countries that we use to compare. One example in Brazil, the cap rates in commercial real estate is around 7 to 8% per year. In Mexico is the same. And US dollar, it's like 5 times our real here in Brazil. It's like $1 is 5 reais. Even though the best returns and the currency risk and the political risks are putting out the money from our region. Mexico and Brazil, less in Mexico, but in Brazil, we are suffering a lot with the political risk.
Richard, there's been a steepening of the yield curve in the US, but pretty sticky 10-year, which is more indicative for real estate. What's your outlook in that regard?
There's lots going on really in US monetary policy right now. I mean, I think in terms of real estate, debt markets are open and very competitive. So, and I think I wouldn't say that leverage is accretive, but it's not negative leverage at the moment. Leverage can be accretive in the United States. And I mean, if there's one blot on the horizon, if you like, for in the US debt landscape, I think lenders are finally, there was a report, I think, in the Financial Times that covered this very recently, that finally in the office sector, lenders are not extending to pretend anymore. They're beginning to get tough. And so we've seen, particularly in the CMBS market, defaults and non-performing loans rising quite sharply in the office sector. So I think credit remains tight for the office asset class, but it's pretty it's pretty abundant, I think, for other asset classes, albeit at a spread of 150, 170 basis points over the 10-year Treasury. So that's the, I think, the debt availability is no constraint on investing in real estate in America. But we do have, to return to my initial point, some concerns about the state of monetary policy in the United States. And although we saw interest rate cuts in 2025, we also saw central bank runoff. So, at the long end of the curve, there was a kind of mixed monetary policy in the United States. Well, that might be, of kind of marginal interest. Really, most people are focusing on the new Fed chair. And there were several candidates. It's now, it was several candidates for that position. And, with the declared intention of the administration, I think, or not declared, but fairly well known intention of the administration to run the US economy hot, with the I think, the desire to deliver living standard gains to ordinary Americans and productivity gains. There is this desire to run the economy hot in a way that maybe under central banks for the last 30 years, there'd always been caution against doing that because of inflation. Then I think, because of that, the markets were watching very closely who was going to appoint the new Fed chair, because without inflation fighting credentials, then I think inflation expectations might have spiked. And we did see, until Kevin Warsh was appointed as the Fed chair, who's perceived in the marketplace to have stronger inflation fighting credentials than Kevin Hassett, who is the other well-touted chair. That gave us that silver and gold spike, and sort of gave us kind of quite an elevated. Markets were very worried about the macro policy settings, the inflation control that the US was going to put in place, I think, for the next 3 or 4 years. And that could have really undermined the bond market. In the end, the new chair, Kevin Warsh, is quite well known and not perceived to be somebody who's going to be weak on inflation. But I would say that there is still concern there, because he's a new Fed chair and we just don't know quite how he is going to run monetary policy in the United States. And inflation, though it is trending down, is still above target. And with the fiscal expansion that's taking place in 2026 and the build-up of debt to GDP ratio, if the new Fed chair says something wrong, or miscues his words, or there's some conflation of data, miscommunication, there could be a very nasty bond market event, and that bond market event would feed straight through. And I think that the kind of potential upside on 10-year Treasury rates, and therefore rippling through the cost of capital to real estate, is, albeit the fundamentals are good and improving, is some sort of constraint and worry, I think, in particular for institutional capital coming into the United States. Institutional capital and core investment is still, making slow progress, I would say. So that's kind of what I'm seeing there. We're still in a new world of monetary policy in the United States, and it's not clear how it's going to pan out. And it could be very positive for real estate investing, or it could constrain it. We just don't quite know yet.
Nick, do you want to reflect at all on what
Yes.
ECB or Bank of England?
Inflation has slowed down in Europe as well as in the UK. This is expected, the inflation also is expected to fall further. There is a trend. For example, in the EU, 2024 was 2.4%, 2025 was 2.1%, 2026 is expected to fall below 1.5%. In the UK also, it's falling down 3.4% 2025, going down to 2.5 in 2026. The low bond yield will certainly assist development, followed by a stabilization of interest rates, and that's going to boost quite a lot this industry that in the recent years has slowed down. In certain countries of Europe, like Poland, for example, which is regarded number 2 or number 3 in the preference rank of foreign investors, development is going on with new buildings, offices, residential, etc., to unprecedented extent. So international investors from the US, from the Gulf, from other regions of the world, prefer Europe, especially certain emerging economies. And we see quite a lot of flourishing real property market in these places.
On the heels of this topic, we did get a question from the audience, so I just want to ask this of everyone now. Have all the regions experienced repricing from the previous very low interest rate debt and possibly value bubbles to support the real estate recoveries being described? And are the banks in your respective regions properly marked on their commercial real estate debt?
That's a good question. I can weigh in there. I mean, yes, the US real estate had a painful period of repricing, which was largely, I think, 22 and 23. Prices dropped across the board 25%, and in the office sector, probably more. It is an open question, I think, with if the 10-year Treasury is at 4.3, I think the long run average spread of cap rates over bond rates in the United States is about 350 basis points, and we're currently at 275 basis points. So there might be some people who would say that we've had that value drop, but it hasn't quite been enough yet, given the uncertainties. I think I might be in that camp. That's going to be a constraint. That is a constraint, I think, on deployment of capital. In terms of have banks marked to market their commercial real estate, well, I don't think there's any problem in the US banking system in the top 50 banks, the money center banks, the systematically important financial institutions have been provisioning against real estate losses and weren't, I think, heavily exposed to the real estate sector. But the United States has 4,600 banks, and many of those are small. They're the regional banks and the local banks, and they're very highly exposed, and they remain exposed. And I don't know that they have fully marked the real estate to market. They've been provisioning against losses, but I think there is still potential danger of banks getting into trouble because of real estate lending in the United States. It's not going to be a financial crisis or anything like it, but we could still see a period of consolidation of small local and regional banks in the United States because I think they have not marked their real estate portfolios to market in the way that they ought to have done.
Any clouds of concern in other regions on this topic?
No, just my comment here. In Latin America, repricing is more selective, like prime logistics and living have held up better, while the secondary assets, especially office, have reset more. That is my comment here from Latin America.
Well, from Asia, obviously, China's banking system seems to have really serious issue, but this is not related to the interest rate, rather too much supply for the development. So it's a little bit different story. And obviously, it is really difficult to see what's really going on inside that country. So I cannot make a lot of comments. But the rest of the Korea has some credit issues, but it's not coming from the interest rate issue as well. So we don't see any significant negative impact because of the interest rate fluctuation in the region. And Japan is obviously enjoyed a deflationary economy over 3 decades, and interest rate is increasing, but many of the corporate slash real estate loans are short-term funding basis, like 3 months TIBOR. So it's like 0.6% or 5%. So it hasn't been like serious yet to have like LTV or DSCR issues. So we don't see any bank reserve issue yet. And also the bank is enjoying really strong capital at this moment. So that's the big picture in APAC.
Nick, in the Eurozone?
Yes, well, the real estate has been undergoing in Europe one of the most significant repricing cycles, I think, in the recent history. And this shift is driven by a wave of refinancing needs, by macroeconomic uncertainty, as well as by higher financial costs. However, because of the lower interest rates now and the possibility to borrow at a lower rate, I think there is a window of opportunity.
I wonder, given most of the markets are in stability or recovery right now, is there a consensus about real estate expected returns on a global basis? Is it mainly income generation as opposed to yield compression? And does that then reinforce the importance of sort of stock picking or emphasis on cash flow generation in real estate investments?
That's a good question. I would say, yeah, I mean, I think there is some expectation, I think, over 5 years that cap rates will come in, around falling inflation and gently falling interest rates. I don't know that it's going to be a very major cap rate compression, but I think most of the forecasts are pointing towards some 20 or 30% basis points off US cap rates, stronger in some sectors, weaker in other. With rental growth, probably, push to keep up with inflation. Maybe towards the end of the period, it'll catch up and exceed inflation. So yeah, I mean, I think the consensus would be, returns, sort of unlevered property returns of the 7 to 8%, of which the majority is going to be coming out of managing for cash flow is really, really the watchword for the near and medium term, and deploying all of the kind of operational expertise that we could in any particular sector is really what it's all about, I think, going into the next 3 to 5 years.
Same in other regions? You had already made reference to the importance of cash flow given the decompression of the risk-free. So,
Well, if you're talking about the APAC market in general, because it's really difficult to say because the cycles are different from country to country. Like for that, Japan is totally behind late in the interest rate cycle because Eurozone, US went through like interest rate increase 3, 4 years ago. Now we're facing that, but still the magnitude is not that significant yet. So due to like really high occupancy in most of the asset classes, many of the investors believe that, particularly we're talking about Japan, the rental growth can easily cover an interest rate increase, which will be probably moderate. So that's like situation. And Australia is obviously easing like a capital market, and I think other dollar-pegged countries are following like a US dollar trend. So those are the two big major, different trends, I think, in the region.
Giancarlo, with higher rates, what's your anticipation there?
Yeah, we don't work high leverage as in US or around the world because the cost of money here it's too high. So the cap rates for sure we are expecting an increase of rents and expand these cap rates, but it's always the same average, like 7-8%. Doesn't matter the inflation and the interest rate, because what happened nowadays, we are reducing the construction, waiting to interest rates going down, because as I mentioned, they don't get some money to leverage their investments. And so here it's more under control than the rest of, for sure, interest rate and inflation affect the investments here, but the impact here, it's more in the phase that we are living nowadays. So we are waiting to reduce and keep construction more assets. At this time, we are just reducing vacancy rate in all assets and waiting what's going on with the interest rate to go to another wave of investments, I hope, in the next 2 or 3 years.
Nick, you want to expand on that?
For Europe, returns will be mainly driven by income, and they vary from sector to sector. We see quite a strong performance in the housing, in the living sector. We see still for the industrial and logistics to see one of the top performing sectors. We see in the offices, the return to office and the prime office assets are in the way of recovery, and some of them have recovered to a significant extent. However, there is a pressure for secondary assets as far as offices is concerned again. In the retail, there is improvement, but there must be found some, I think, more attractive strategies. And for hotels and the hospitality sector, since there is an explosion of tourism, especially in Europe, this gradual improvement that we see will very soon. I very much doubt that it will meet demand. That there is a real explosion of demand in the European tourism industry. So these type of assets are becoming more and more attractive for foreign investment.
Thank you. We are running up on the hour, and we're not going to be able to get to some of the other topics, but there are some questions that are coming in. This one is geared to Yasushi. How do you see the enormous oversupply of residential units in China being resolved? How will this impact the emerging middle class?
That's a very difficult question, to be honest. And I think it will take very long time to solve the oversupply of residentials. And another big issue for China is, although it has a lot of people right now, but they have a single kid policy for a long time. So their labor workforce population is already declining, and their population is going down sharply. So it's like even if you pick up somewhat for the liquidation of like existing residential market, but along with that, the number of people is reducing in China. So to be honest, I don't know when that issue can be solved, and also Chinese government is trying to not to disclose the reality to the rest of the world. So it's really difficult to foresee what's going to be happening. But they are trying to follow the Japanese way, which we faced like really big real estate bubble issue in 1980s, and we spent 25, 30 years to solve that. So some says that China may be taking that way to gradually absorb the losses over decades.
Let me throw a question out to everyone. This was posted. Is investment in India accessible and of interest to investors?
Good question again. And unfortunately, I have almost no experience in India. The thing I noticed that is foreign exchange regulation used to be very tight. And once the money is input, then it's really hard to pull out. But I think that regulation is getting less and less. So for global players, it gets easier to infuse capital into the Indian market. And obviously, AI booming is a big driver for success of India. So I believe Indian market is a really prosperous outlook at this moment.
Richard, do you have any opinion on this too? Given
Yeah, I'm largely the same opinion. I think India is of great interest to investors around the world, given its continued high rate of growth. And I've said, to colleagues in the States, if you want to look at think about the future of the office, go to India because the office sector is thriving. And not only has it got a domestic service sector, which is growing. It's got a hugely thriving global outsourcing sector. So the economic growth rates are high. The real estate fundamentals are good. It's of great, the REIT sector is developing. It's not, it isn't the answer to everything yet. But I think, as Isushi said, I mean, putting capital into India is not necessarily hard. It's accessible. There are routes in. It's getting capital out of India that has, traditionally been a problem, and it's getting easier, but it's not quite straightforward. If you're a long-term player with good local partners, then I think that's or you invest through REITs. That's the way into India. But in terms of interest, absolutely, it's of great interest to investors around the world.
We see out of a sudden so many world leaders going to India. That means something.
Yeah, absolutely.
Right. So it looks like we're up at the end of the hour. Before I turn it over to John, I just want to thank everybody for a really fun and informative roundtable. So, John?
Thanks, David. Let me thank the panel for a terrific roundtable. It was very interesting and very well done. I always appreciate that each of you are willing to take the time and do this kind of thing for us. Thanks to the audience as well. And please join us on March 12th for a special presentation from our esteemed Economic Advisory Council. It's always one of the most popular webinars of the year. Watch your email for details, or you can register right now on our website at cre.org. On behalf of the Councils of Real Estate, thank you for attending this session of What's Next for Real Estate and the Life Experience.